Okay, here's our chapter 14 video when we're talking about long-term notes payable. And we start out here, we're talking about different ways to raise money. So if you can relate this to you or to a company. So the main way most people earn money, right, is through a job, or for a company that would be their revenue or their net income. So you can, if you need more money, you can try to cut expenses or raise your revenue to increase your bottom line, your income. But sometimes that's not enough, especially if we're talking about large purchases. So if you need more money than your job can provide, you could sell stuff, right? You could sell things that you own, and so that is the equivalent of the equity that we talked about in the previous chapter, selling common stock and preferred stock and stuff. The other way is to borrow the money, either from a bank or from somebody you know, and that is for a business the equivalent of debt. And so we'll talk about a couple of different things and compare this. If I need additional money, whether I want to raise it through equity, through selling stock, or through debt, through borrowing or through bonds. And the debt, we've got this risk versus return thing. It has the potential to be more profitable. It can be cheaper and raise more money, but it also has the potential to be riskier. We talked about when we issue stock, if we're going through some lean years, we don't have to pay cash dividends or stock dividends. But with debt, you have to make the payments, and you have to pay the interest no matter what. So it can be riskier. Shareholders often like this because it can increase the shareholder return. If I raise money through equity, then I can raise revenue through whatever I'm doing, but it's spreading across more people now. So there's not one right way to do it, and we'll come back to this kind of at the end and compare it. So we're going to talk about two kinds of long-term liabilities. The first would be notes payable, and we did this in Accounting 1, where when we went from accounts receivable to notes receivable, and it became like a long-term thing when somebody's accounts receivable was due and they needed some more time, and then it became a more formal type of debt, and now I'm going to charge them interest. So this is just the other side of that. This is just from the borrower side. So we're talking about when it's more than a year, so something that is due more than a year from now, and now I will have to pay the principal plus the interest. And the interest, and again, this should be fairly familiar because this is similar to what we did over in Accounting 1 when we were on the receivable side. But the interest payment will be the principal times the interest rate. That will give you what your annual interest is. And then generally these are not for the whole year, so we would take that times the number of months over 12. In this chapter, most of the payments that we're talking about would be either annual, where it's just 12 over 12, or it'll be semi-annual, so it'll be 6 months over 12. So if it's semi-annual, we'll take the annual interest rate and then just kind of divide that by 2, by 6 over 12. For example, if I borrowed $100,000 at 6% interest with semi-annual payments, I would pay $100,000 times 0.06, and then this would be for half a year, so 6 over 12, or 0.5. And so I would have $3,000 would be my semi-annual interest payment. That's just the interest. In these, you're going to have to pay the principal plus the interest. And in most of these long-term notes payable, what you'll see is you've agreed to pay $5,000 principal plus interest. But as I start paying on the principal, this amount that I use in my interest calculation will keep going down. So if I agree to pay $5,000 every 6 months plus interest, the payment will keep going down because it's always going to be the $5,000 principal, but then your interest calculation will keep going down because it'll be 6% of a smaller and smaller amount. So your book has some amortization schedules to kind of show you what that looks like over time. It's the same type of thing for mortgage payable too. Some of those are in there. It works a similar way, except They just kind of, the total payment stays the same, and it's just the amount of your payment is mostly interest at the beginning, and as you go, it's less and less interest and more towards the principal. But it's the same type of thing there. So in this example, I'm going to actually put a couple problems in here because some of these things I think really need some problems to show it. On January 1st, Locker Farrell signed a $200,000 10-year 13% note. So the note is an IOU, right? So the person issuing the note or signing the note is the borrower. The person who received the note is the lender. This requires them to make annual payments of $20,000 plus interest. So when we issue the note, Locker Farrell, the person who issued the note, gets cash because they're borrowing cash, and we credit the liability notes payable. So I'll debit cash for $200,000, and I'll credit notes payable for $200,000. Now, every time I every time I make a payment, I'm going to debit notes payable for the principal, and then I'm also going to debit interest expense. So I'll debit notes payable, and they agreed to pay $20,000 in interest. So I'll debit the amount I owe them to bring that down by $20,000. Then I'll also have to debit interest expense. So the interest expense will be how much I owe, the balance in notes payable, so the principal that's left is $20,000 times 13%, and then this is for a year, so that would be 12 months over 12, so I can just kind of skip that part. So 13% interest would be $26,000. So $26,000, so the total cash that I have to pay them is $46,000. Now, it doesn't ask you to do this, but let's add number 3, and we'll do the second note payment, which would be at the end of 2017. So again, I'm going to pay $20,000 towards the principal, so that'll be $20,000. Yeah, $20,000. The interest expense is going to be a little bit lower though now, right? Because they had $20,000, they paid $20,000, so the balance before this payment is $180,000 on the principal, times 13% times 1 for 1 year would bring us down to $23,400. So the interest is down because I paid off part of that principal. $23,400. So the total cash that they have to pay over is $43,400. And so that'll keep going down as we go, as we calculate that 13% on a smaller and smaller balance as I pay that down. So that's a note payable. Now we're going to get into bonds. And so again, a bond is a form of debt. It's an IOU. And so the issuer of the bond is the borrower. That's the person borrowing the money. So some terms that we need to understand as we go through here. The face value of the bond is the amount that has to be paid back when the bond matures, when it's due. So this is the amount paid back at maturity. You will also see this called the maturity value. It's also called the principal. It's also called the par value. So those terms are all kind of interchangeable here. And they all refer to the amount that has to be paid back when it's due. The maturity date is when the bond is due, when the face value is due. Now this is a little bit, the notes payable, I was making principal payments throughout the life of that. In this one, I borrow the money up front, I make interest payments throughout it, and then I pay the entire principal back at the end, at this maturity date. So I don't make payments on the principal as it goes. We will also, the bond will have a stated interest rate, and this determines what those payments are going to be. Determines the interest payments that I'll pay throughout the thing. This is also called the coupon rate. You see that one a lot. So the coupon rate is the stated rate of interest. Now, the market value of the bond might be different than the face value. And we get into this by comparing the stated rate of interest that's on the bond to the market rate of interest. So they come up with a bond issue, and so let's say they need $1 million. They're probably not going to issue one bond worth $1 million. They're probably going to have 100,000 $100 bonds or something like that. So we're spreading it around to different people, and so I might not sell them all. I might not issue them all at once. So when I first came up with this bond issuance and authorized this, by the time I actually sell some of these, the interest rate may have changed. That's why sometimes these are different. Types of bonds, there are serial bonds, which means that batch will come due in a staggered fashion, whereas term bonds, in my example, I had 100,000 bonds. So in the serial bonds, they might come due, they might mature over several years, whereas term bonds, all of them will come due at the same time. There are also secured bonds and debenture bonds. So this is just like a secured loan where it's backed by some sort of asset. So for a secured bond, if they fail to pay back on the bond, you would have a claim to some of their assets, whereas a debenture bond is not. So that would be a little bit riskier and would probably pay more just to attract people for that. Now the bond price, what they issue it for. So when they issue the bond, they get cash, and then when it matures, they pay back. And those two amounts aren't always the same. So the bond price is, we're going to compare, it's determined by the stated rate of interest. So the stated interest rate, the current market interest rate, and the length of time for the bond. There's an appendix in this chapter that goes into this in much more detail, because we're factoring all kinds of risk and time value of money and all kinds of things like that. But for the, and I do encourage you to read that, but we'll do some time value of money stuff later on. But basically, if the stated rate that the bond is paying, if the stated interest rate is greater than what the current market rate is, I can sell this bond at a premium. Everybody's going to want mine. If my bond is paying 10% and the going market rate is 7%, everybody's going to want my bond. So I can actually charge more. And I can use that extra to offset the fact that I'm paying higher interest rate. If the stated interest rate is less than the market rate, nobody's going to want mine, right? Because they could get something else. So I have to sell it at a discount. So I have to kind of mark it down to get people to sell it. And if they're the same, then it's just selling at its face value. So let's do a couple examples so you can see that. So this is how you'll see it written. We'll start with this one. If the market rate is 8% and we're issuing bonds with a stated rate of 7.75%, what I'm paying is a little bit less than the market rate, so I would have to offer this one at a discount. In this one, I'm paying 9% bonds, and the market rate is 8.5%. So I'm paying more, so I can actually charge more for this one. I can sell this one at a premium, and people are willing to pay more because the extra interest they'll earn throughout the life of the bond will more than make up for what they're paying now. And in C, we issued at 10, the market is 10, so that one's just at its face value. And the last one here, we have a stated rate of 8.5, the market rate was 10.5, so this is a discount. And as you might guess, this is going to be a bigger discount than we saw in A. In A, we were only a 0.25% below the market value, so that would be a very small discount. In this one, it's much, almost 1.75% below, so that's going to have to be a higher discount. The bigger the difference, the higher the discount or the premium. So this next problem kind of shows you what these things will look like. So this is how. So we are issuing 8% bonds, $500,000 worth, and this is how you say it: issued at 75.5 or issued at 102. And basically, what this means. So here's the face value in all of these is 500,000, and then you take that times this issue price. That's what this is right here. This is the issue price. If it's below 100, it's a discount. If it's above 100, it's a premium. So this is a premium, this is a discount. Because what this basically tells you is how much of that face value you're getting up front. So for this first one, it's issued at 75.5, which means you're getting 75.5% of the face value. This is that'll give you the market price of the bond, which is basically the cash you get. So in this case, you're getting 75.5% of that 500,000. So cash you get now, we'll say at the beginning. So that's 377,500. So what that means is they're going to give you 377,500 now, and when the bond matures, you have to pay them back 500,000. That's the difference between the market price and the face value. The difference is the amount of the discount. In the second one, the face value is still 500,000, and I'm issuing it 102.75. That means I'm getting 102.75% of the face value. So I take that times 1.0275. In each case, you just slip in the decimal place over two places. And so I'm getting $513,750 now, and when it matures, I pay back $500,000. So that one's a premium. On the third one, 500,000 times 0.965. So again, this is a discount, but it's not as big a discount as the first one. So this market price is going to be closer to the face value. In this case, that's 482,500. And then in the last one, the face value is still 500,000 times 1.025. That means the cash you get now is 512,500. So it's a premium, but not as big a premium as number 2 was. The second part says, which one will telecom have to pay the most to retire at maturity? And this is sort of a trick question because they're all the same. Regardless of the amount of cash you got now, all of them require you to pay back the face value at the time of maturity. So the discount will affect the cash you get now, and it'll affect the interest a little bit there, but it will not affect the what you have to pay back at the end. Let's see. This next one says, Quick Drive-Ins borrowed money by issuing $4 million of 4% bonds payable at 96.5. That's how you'll pretty much see these written. So how much cash did they get when they issued the bonds? Well, this is what determines how much cash we got. So they would got the face value of $4 million times 0.965. They got 96.5% of that. So they got $3,860,000 cash when they issued the bonds. How much do they have to pay back at maturity? That's always the face value. So that's $4 million. And then how much interest will they have to pay every 6 months? That's what this one determines, all right? The stated interest rate. So $4 million times 4%, and this is every 6 months. So 6 over 12 or 0.5 means their semi-annual interest payments will be $80,000. So when they issue the bond up front, they will get the $3.86 million. Then twice a year for the life of this bond, they'll pay $80,000. Every 6 months, they pay $80,000 in interest, and then when the bond matures, they pay back the $4 million. That's how that works. So now that we know how to calculate all these things, let's put in the what the journal entries will look like. So if I issue the bonds, so let's do issuing the bonds. Let's say let's make some nice small numbers here. I'm issuing a $500 bond. Okay. If I'm issuing it at face value, I would debit cash, and I would credit bonds payable. That's the liability, that's the money I owe for $500. If I issue it at a premium, The cash I get is something more than what I owe, right? So let's say I got $560 in cash. I'm still going to credit bonds payable for the face value. That's always going to be for the face value. So that's the 500. And the difference goes to premium on bonds payable for $60. The difference between the cash you got and what you owed. If I issue it at a discount, the cash I get is something less than what I owe. So let's say I got $450. I still have to credit bonds payable for $500. So the difference, the $50, goes to discounts on bonds payable. I think this is getting a little bit long, so I think I'm gonna split this one into two parts so that it's a little bit easier for you to watch. So let me stop this one here, and then we'll come back and pay some interest and retire some bonds.